Hi, good evening, everyone. Welcome to today's webinar on extracting alpha and discovering hidden growth vectors in the US markets. We're really happy to have you join with us today, to explore how scientific investing can help you unlock unique growth and opportunities in one of the world's largest markets. In this session, we will talk about the investment philosophy behind the Stockal Omni Global Value Fund and how it's designed to capitalize on below the radar growth vectors such as AI, fintech, healthcare, and digital transformations and more. Our goal for this webinar is to help you understand how this hedge fund will help you. uh, it's also my pleasure to introduce with today our distinguished guest and expert speaker, Dr. Vikas Gupta, CEO and Chief Investment Strategist at Omniscience Capital Advisors. Dr. Vikas brings extensive experience in scientific investing and global equity markets. His team strategies have been recognized globally, including being ranked number one long-based equity strategy worldwide by Perquin in 2014. Today, Dr. Vikas will, talk about how unique this fund's approach is, the scientific investing framework, and how it leverages transformative technologies and market inefficiencies to generate alpha. Dr. Vikas, over to you.
Thank you. Welcome, everyone. So let me start with a few examples so that immediately you will get the point of what's happening. So 2016, Apple even then was the world's largest company. The market cap was $520 billion, net cash of $160 billion. So effectively, market cap minus the net cash gives you the enterprise value. Somebody, if they wanted to buy the whole company, they would pay $520 billion. They would get $160 billion lying in cash in the company, right? And so effectively, they ended up paying $360 billion. So the whole company, Apple, was available at $360 billion, while the profit, the PAT, was $53 billion in that year. Okay, so you can see that on a PE basis, 520 by 53 is roughly PE of 10, but enterprise value to PAT would be just around 7. Okay, and why was Apple selling for a PE of effectively 7? Okay, so you have to understand there was a lot of negative view on Wall Street as far as Apple is concerned. It was 2011, Steve Jobs had passed away, and it was 2016. No new products had been launched. Growth was slowing down, and the investors and Wall Street was worried that Apple will stop growing. And so it was very negative sentiment. Now, what did we see when we were looking at the same situation? What we saw, a company with a PAT of 53 billion, free cash flow of 70 billion, okay, which gives an enterprise value to free cash flow of nearly 5. So for crude sense, you can just think of it as something available for PE of 5, right? So PE of 5 or 7, in all cases, or even 10, it's very, very cheap. Secondly, company had announced a buyback of $250 billion. $500 billion market cap company had announced a $250 billion buyback over next 2 years. So 50% of your money was going to come back in just 2 years. The company had a 1 billion installed base of devices. So when we say device, it means everything, right? It means MacBooks, it means iPods, it means iPads, it means iPhones, everything. So 1 billion installed base. And the typical replacement cycle is 3 to 5 years, right? So you are going to replace, which means 250 million devices are to be sold every year. Okay, which means we are not worried about sales. Okay. Now that the sales are stable. 250 million devices every year. The sales are stable. Now, what about growth? So look at the R&D. The annual R&D was $10 billion at that time. Okay. Now, if you take R&D doesn't, is not really used up in 1 year. So last 5 years or last 2, 3 years and next 2, 3 years, the whole R&D is will last you for 5 years or more, right? So the 5 year R&D budget would be something in the range of 30 to $50 billion at that point of time. Now, most of us don't have a feel for what does this mean. That is why I'm comparing it with venture capital, because venture capital is also about new products, new companies, new services, and R&D is also about the same thing, right? Broadly speaking. So when you say $50 billion, you compare it with the whole of US venture capital assets under management in 2016 or 15. So that was about 300 billion. How many unicorns are expected out of 300 billion? Out of 300 billion, at least 1,000 unicorns are expected. Okay. Or at least 100 unicorns are expected. Now, out of 30 to 50 billion, how many would emerge out of Apple? So you can imagine that growth was not an issue at all, given the R&D happening. Sales continuity was not an issue at all, given the $1 billion buyback. 250 billion out of the 500 you paid, if you acquired the whole company, if you were the single owner, you would be getting back half of the money in next 2 years. So that's like a 25% return for next 2 years, right? And all of this we captured in an article in the street.com in 2016. So that article is published in 2016. So you can look at it, and now so the $500 billion company is now 3.5 trillion, 7 times. In roughly 9 years, it's gone 7 times. I'll give you a couple more examples here. Netflix, okay? All of you are familiar with these companies. That's why I'm giving them. World's largest streaming platform. So in 2022, the Wall Street was extremely negative on this company, and it was selling at close to $100 billion. Okay. The whole company. There was increasing competition from Disney Plus, HBO Max, Apple TV Plus, Amazon Prime, right? So a lot of other apps were coming, streaming apps. So people were concerned about the increasing competition. The Russia-Ukraine war, they had shut down their services in Russia, which ended up being increased, naturally, the loss of subscribers. They had increased the subscription prices for shared logins. So people used to share with family members or friends, right? So they said you can share, but you'll have to pay more. And that was considered a negative from Wall Street point of view. That will end up in losing subscriptions. And there was saturation in core markets like US. With 75 million users, it was assumed that it would be very difficult to grow further within the US market. And there were first subscriber losses after a long time in 2022. So decline of 200,000 in Q1 and 1 million in Q2. So all of this end result was that it was selling at 100 billion or so, around that range. Okay, the whole company. What we saw. So OmniView, there was a company which was generating $5 to $6 billion operating profit. And compared to all of the competition which I just mentioned, Disney, HBO, Apple, all of them put together, they were losing $10 billion combined. Okay. So that was one big contrast. We expected continued growth in core and new markets. So there are, of course, core markets that would grow slowly because you're already at a very high number. But the new markets were still open. A lot of new markets were there. I mean, just for comparison, Facebook has 3 billion users and YouTube has about 2 billion users, 2 billion, right? And these guys are at 225 million in 2022. So there's a long way to go. Okay. On top of it, they were coming up with a low-priced subscription model, which would be supported by advertising revenues. And then we dug into the advertising revenues, how it would happen. and how much they could expect based on how things were happening at YouTube or Facebook or Instagram or TikTok. And it could contribute quite a lot, significantly to the revenues. Free cash flow was expected to increase because the company had been investing for more than 10 years in content at roughly average of anywhere between 10 billion to 17 billion every year. So that was creating a huge base of content which you should rival somebody like Disney. Okay. And so now they were confident that they could start reducing, or let's say just optimize at around 17 billion. While the revenues kept increasing, they would not have to increase the expenditure on content. Subscribers were roughly evenly divided between North America, 75 million, Europe, Middle East, and Asia, 75 million, and rest of the world, 75 million. Okay. Sorry, Europe, Middle East, and Africa. And rest of the world, which is mostly Asia and Latin America, 75 million, right? Roughly equal, but the subscription revenues are much more from North America, right? So we could divide the MCAP into 115 billion, which was the total MCAP at that time. And we would say 60% because like even if you look at any other companies, the advertising revenues wise, American subscribers are much more valuable. So I would say 60%, this is a very crude analysis, 60% value to America, 30% to Europe, and 10% to rest of the world. And that would value each American subscriber at just below $1,000, $933. The European subscriber at 467, just below 500, and rest of the world at around 160. Okay. Now, having valued it by the market at these prices, compare it to the valuation of cable TV subscribers. So we have to look at other subscription models, entertainment subscription, and at peak when cable TV was nowhere going to be destroyed, right? So 2007, cable TV was at peak. There was large growth expected in future. At that time, conservatively, each subscriber was valued at $4,000. So you can see the kind of discrepancy the market was making as soon as you looked at it from a different perspective, value per customer, instead of just looking at the PAT and all that. And of course, even the PAT was not at all bad. Okay, so 20 PE at $5 to $6 billion operating profit, that was around 20 to 30, 25 PE. Okay, net of taxes. So you can see what kind of mistakes, since absolutely, I mean, the largest company we just saw in the world, people are making mistake. Now, this is one of the most well-known companies, Netflix, people are making mistake, and these are the sophisticated Wall Street guys. Now, I'll tell you the third one, Meta. Okay, again, 2022, the Wall Street view was that first time Facebook reported loss of daily active users. Okay, Q4 21. And so Wall Street was extremely negative. Second, there was huge skepticism on Meta's move to metaverse. So they had announced that they will be developing and investing in metaverse. So it was seen as a drag on the earnings. They had laid off more than 11,000 employees, nearly 13% of workforce. So it was viewed negatively that, you are mismanaging the company. And the economy was slowing down and there were cuts in ad spend, etc., because of various things. So now, what were we seeing, OmniView? We saw a highly entrenched company with nearly 3 billion daily active people and about $8 annual revenue, okay, per user, per subscriber, monthly revenue per subscriber. We were positive on the metaverse. So post that, metaverse has been getting a bad name even now. But if you think about the metaverse combined with the virtual reality and wearables, and you keep in mind that now with AI, generative AI, creating a metaverse is extremely cheap. Okay, if you keep all of these things in mind and think about 2030, somewhere around 2030 or plus minus couple of years, it is expected that smartphone, the phone you carry in your pocket, will not be the main device. The main device would be some kind of a wearable. And the primary wearables which are likely to replace the smartphone is likely to be the glasses, smart glasses combined with a smart watch. And most likely the device will be in the watch, and this will be the display and camera and the earphones, etc. Okay. And so you see, they have already launched Ray-Ban Meta, right? The Meta glasses with co-branded with Ray-Ban. And there is Meta Quest, which is the virtual reality system, and so on. And even now, I mean, for example, we are interacting on a video call. This in future would be a 3D video call where we could be seeing each other. Okay. So that's the difference, and that future is still there. And this is what we saw, and this is what we think Meta has inside of it. Of course, many other companies could do it as well. And so the operating cash flow was $50 billion. R&D was up 20%, so they were spending a lot of money in 30. Capex was up 30%. Okay, and so growth was bound to happen given the kind of capex and R&D they were doing. Uh, if you compare, the full company was available at around 300 billion. Okay, and you were getting 50 billion in operating cash flow. So again, you can see the kind of 7 times P ratio roughly in compared to the cash flow, EV to cash flow. Okay, so we put down FCF yield as nearly 8%, 7.8, right? So there is about a 12 times EV to FCF. P is 12 as well, and EV to OCF is about 6 or 7. So again, so these three examples, and now you know what it is. So the $300 billion Meta is around 1.6 trillion. Okay, just in 2 to 3 years, 2.5, 3 years. Okay, so that's about what 300. It's about 6 times. Okay, 5 to 6 times. Similarly, Netflix is around 500 billion plus, which was around 100 billion, so around 5 times. So these kind of things you uh, can happen. Now, now that you have understood that even in the major well-known companies, there can be huge mispricing by Wall Street. Now is the time to ask the question, how to spot these things. Okay. So we spotted these things using what we call the scientific investing framework, which is based on the Omni insight that in the markets, most participants chase alpha, but they will get risks, while one could chase safety and get alpha. So how do you do that is the whole framework about. Okay. Our investment focus is US, AI, and India. So today, of course, our focus is on US, and AI is significantly represented in the US uh, allocation. So concept of scientific investing based on our Omni insight, which I just shared, is enhanced safety, enhanced growth, and enhanced returns. But first is safety, next you look at growth, and then the result is the enhanced returns. So it is basically results in a supernormal portfolio, which is designed to survive through uncertainties and thrive on the below the radar opportunities, thus delivering optimal return on safety. So just as an example, I'll tell you, in March 2020, we went through all the companies we had in the portfolio, every single one, and we did an analysis, the stress testing, where we said what happens because the lockdowns were just about to happen. And we said, okay, we don't know indefinite lockdowns. How long are these companies going to survive? First criteria was if all the companies had zero revenues and 100% of the expenses, how long would they survive? And our range was somewhere between 2 months to about a year or so. Then next level of stress test was that you don't have to do full expenditures, right? Revenues would be zero, but you don't have to do full expenditures. So if you reduce the expenditure, at least the variable ones which are not required, if you're not selling anything, you don't have those variable expenses, right? You'd only have the fixed expenses. So if you did that, and the result was anywhere between 4 months to 2 years. So that is how the portfolio is designed to survive and then to thrive. You have already seen some examples, and we'll give you more reasons why. So this framework has evolved over multiple decades. We don't have time to get into the details of that today. You can look up later on, but it's over a long period of time with a lot of scientific thought process behind it, lot of observation of markets, lot of deep research on more than 100 years worth of practice and research of investing. Okay. So this is based on that 100 plus years of investment management history. And these are some of the core concepts, which is margin of safety is the most important concept. That if you pay, so margin of safety comes from engineering, right? When you design a bridge, or even simpler example, if you are in the elevator or the lift, typically it says, 680 kgs, only 7% allowed, and so on. So when it says 680 kgs or 7 people allowed in the elevator, it actually means that it's designed for maybe 1000 kgs or 800, 900 kgs, and it can actually allow for 8 or 9 people or even 10. And there is a margin of safety. So if people don't follow the directions and some more people get in, the lift is not going to crash. Okay. So that is the idea of margin of safety. It's called safety factor when they do engineering design. We have applied, not we, Warren Buffett's guru, mentor, Benjamin Graham, he came up with this idea 100 years back. We just like it because of our background. Second is growth investing. We already discussed how growth matters a little bit. We will talk about it more. Third is discount to intrinsic value. So each company has some kind of an intrinsic value. And many times in the market, as we saw in the last three examples, things are available at significant discount to the intrinsic value. So something worth $100 is available for $50 or $70, or sometimes as low as $20 or even $10, right? So we saw, I mean, Apple is up 7x. So you can think something around, it must be available at $20 instead of worth $100, right? So the largest company in the world was available at such large discounts. Then the concept of diversification, you don't just buy one stock. That's a recipe for disaster. Oh, give me the next Microsoft or give me the next Facebook or Apple. That doesn't work. Okay, nobody knows. You can increase the probability, and you need to have, I mean, if the venture capitalist knew, they would just invest in one company, right? But a venture capitalist invests in 20, 25 companies, and they have a series of such funds. And over next 5 years, they invest in the 5 series funds and total of around 100, 125 companies. And out of them, 1,000 bagger emerges. Okay. Something which becomes 1,000 times. And that pays for all of the other 100 stocks. The returns, the whole fund returns are coming out of that one or two companies which become mega unicorns. So diversification is important. To actually get growth, you need diversification. I mean, the growth in the portfolio. Warren Buffett has a principle, says there are only two rules to investing. Rule number one, don't lose capital. Rule number two, don't forget rule number one. So risk of loss of capital, we have to be very careful. And that doesn't mean the portfolio will not go down. Portfolio will guaranteed go down. In stock market, if you are long biased, you will guaranteed fall. Berkshire Hathaway itself has fallen by 50% or more at least 3 times. Okay. So you cannot get out of it. Otherwise, Warren Buffett would have sold off the shares, and when it fell, he would have bought them back, right? So he didn't do that. Moat investing. So there's a concept of moat. These are basically companies which are highly competitive. They have huge competitive advantages and you can't enter them. Competitors will have very difficult time getting into their market share. So those are called moat companies. So let me run through the whole framework now. This is the most important slide. This and the next one, right? So you start from the whole universe. A typical universe for us is the S&P 1500. So S&P 1500 means the S&P 500 large cap, S&P 400 mid cap, and S&P 600 small cap. All of them put together is called S&P 1500. So out of this, we start first with taking out companies which are capital destroyers. We call them capital destroyers. The typical characteristic of these companies are they are highly leveraged. They have a lot of debt. So the debt is very, very high. It might be just borderline. They might be on the verge of collapsing. So whenever it crosses a certain level, it becomes very risky. And we don't like those kind of companies. So we take them out. And out of 1500, this will take out around 600 odd companies, 600 or 700. So there are such highly leveraged companies. They're consistently loss making. Okay. Once or twice in a few years, they might make profits when the economy is really good and something. There's huge demand for their products. But usually they are on the verge of collapsing. So by taking them out, we have reduced the chance because out of those 600, 700, around 50, 60 are likely to go bust in next few years. And you would lose capital. And if you bought the whole ETF, like there was a S&P 1500 tracker, you would have those companies in your portfolio while they will be losing money for you. So you don't want them. So we remove those companies. Okay. Next comes what we call capital eroders. These are companies which do not have any competitive advantages. So they are there, but they are competing on price. Suppliers are, forcing them to buy at high price. Customers are forcing them to sell at low price. Employees are forcing them to pay high salaries. And so they are losing money from all directions. So they don't have any competitive advantages. These are called capital eroders. They're still listed because maybe they were actually having competitive advantage at some point. Now they're listed and they kept losing that advantage, but they're still listed. They're still part of the index. They're still owned by ETF owners or index owners, right? But they are losing money for you. They're not even earning the cost of capital. So they're not compensating you for taking the equity risk. We take such companies out, capital eroders. The third group, now all the companies which are left are either good, at least good, or they might even be great. But there is still a challenge. The challenge is lot of very good companies are extremely overvalued because market knows. And just like market is negative on something, the three examples will give you. Some other time it becomes very positive. Wall Street becomes very positive, and the price goes way above the intrinsic value. So something is worth $100, it's selling for $300 or $500. So even the most optimistic projections for the company don't justify the price. So those kind of overvalued companies we call capital imploders, and we take them out because in future they're going to lose money despite them doing so well. So imagine a company is priced in a way that you're projecting 20% growth for next 20 years. And 5, 6 years down the line, the in the earnings call, the CEO comes and says, "Oh, we now can't grow at 20%, we'll grow at 16%, which is an amazing growth rate." But the stock price is going to implode by 40 to 60% in a matter of days or weeks. Okay. And that's how you keep making money for 4 or 5 years. And one day you just lose money on such overvalued companies. So we take out those companies as well. And now we are left with capital multipliers. So let's say somewhere between 80 to 150 companies will be there, depending on where the markets are. When markets are extremely in a bull market peak, then we will get around 70, 80. When it's in bear market, we might get 150 plus, right? So this is capital multipliers. And now I've shown you something completely contrary to what is typically taught, which is high risk, high return, low risk, low return. High risk, high return, low risk, low return applies to asset class. Fixed income is a low risk asset class, it gives you low returns. Equity is a high risk asset class, it gives you high returns. Once you are in equities, that doesn't apply. Rather, lower risk is higher return. I just showed you, I reduced 3 levels of fundamental risk, right? Risk of capital, complete capital destruction in destroyers with weak balance sheets. slow capital destruction with eroders, and sudden capital destruction with imploders. Now, three levels of safety we have increased in the portfolio, and that's why three levels of alpha is there, because our portfolio doesn't have those money losing buckets. Okay. And so we are at capital multipliers. And now we can do still better. So enhanced safety is done. Now we come to enhanced growth. And here we go through each and every company and try to see if it has been growing historically, number one. Then we want to understand why it has been growing historically, because it could be a COVID blip for sanitizer or PPE kit companies, right? So there's some specific product on a specific event, and that would show a high growth rate for 2 to 3 years or a short period, right? We don't want that. We want to see companies which are growing on a secular basis at a high rate. And for that, we try to understand what is driving that growth. And that growth should be driven by pull. The market should be pulling. Market as in not the stock market, the economy, the people in the economy, different segments. So for example, I'll give you like Coca-Cola was considered as the greatest investment by Warren Buffett. When he was asked that if you had to invest only one company, if the market was shut down for 10 years, what would you buy? He said, I'll buy Coca-Cola, right? Now that doesn't make sense anymore because the whole social trend is to shift towards healthy drinks, non-sugary drinks, right? So someone making healthy, organic, fitness-oriented beverages or food products would get a huge tailwind, huge demand coming, right? So that is something we call a growth factor, which will last for next 5, 10, even 20 years. So it could be socially driven, like this example, or it could be AI, right? So AI is going to impact everything, and that's technologically driven. So it could be social, it could be technological, or it could be political. Okay. So things like or environmental, right? Or regulatory, right? You make a regulation about pollution. And so some things which are polluting are going to get disrupted, their market, and things which can help with the solution to pollution are going to get a huge market tailwind, right? So it can be all these kind of drivers. So we look for growth vectors. We look for whether the company is benefiting from that. We look for whether the management has a strategy to monetize on that growth vector. We look for whether we are satisfied with the strategy. If all these things are true, the company has already got a strong balance sheet. It has already gotten, because it's not part of destroyers, it's already got huge competitive advantage. Otherwise, it would be out in eroders. It is fairly priced because otherwise it would be imploders, or it is probably at a huge discount to intrinsic value. And it is now exposed to large growth vectors, right? So it's a great company and it deserves to be in a portfolio. So this is how we do the selection. And in a portfolio, we have multiple growth vectors and multiple companies. So typically we want to have 20 to 25 companies. Sometimes we might go as high as 40 or 50 as well at the bottom of the market, right? And at peak minimum, we want 20, 25 companies in the portfolio. And we want multiple growth vectors. So there'll be multiple industries, sectors, as well as 4 to 5 or even 7 growth vectors. This is how, what is a growth vector, etc. I've already explained most of it. These are some anomalies, how you get different kind of anomalous patterns when Wall Street makes mistakes. So you just given 3 examples. I think that is sufficient to understand for today. And finally, this is the Omni Global Value Fund. Omni Supreme US is the strategy. And it has numerous below the radar growth factors. Why US economy is, of course, you know very well. It's got nearly 1/4 of the global economy, more than 40% of international market revenues in the US listed companies. So when you invest in US, you get exposure to US economy as well as you get exposure to rest of the world. Okay. And 1,500 plus companies to choose from, which are all $1 billion plus, from $1 billion to multi-trillion dollars. There are more than 100 companies in US which have grown at 20% CAGR, compounded annual growth rate for last 10 years. And 50% of global market cap is in US. Lot of innovation from tech perspective, non-tech perspective is happening in US. So you need to have that exposure, very critical. AI revolution is here. I already mentioned that's one of the important growth factors and it's part of the portfolio as well. So these are the current segments and they keep changing. See, the growth vectors we are exposed to keep changing as we realign, rebalance the portfolio, right? Something becomes overvalued, we'll throw it out and we will be buying new stuff. But today it has got the AI ecosystem, digital transformation, metaverse. These are the tech oriented things. Then you have athleisure, you have healthcare, biotech, pharma, medtech, various aspects of healthcare, right? Including some tech platform based on related to healthcare. Then there is travel and leisure, which is again a very broad based thing, which has different companies. And then ad tech, e-commerce, so advertising technology, because now everyone is using apps, it becomes very critical, and a lot of companies make money through advertisements. So ad tech is a very critical piece, which we don't see; it's hidden behind the scenes. E-commerce we are all familiar with, and then how do you do e-commerce? It's with fintechs and payments, right? So all of these kind of things, including renewable energy, is likely to be added now. So this is the kind of exposure. As you can see, it's quite diversified in terms of the growth vectors. We already discussed athleisure market, which is extremely large. Then the ad tech and digital commerce, which is again multi-trillion dollars. Healthcare wellness, again multi-trillion dollars. Fintech and payments is again the total digital payments globally is 25 trillion plus. Travel and leisure, again, trillion plus. Right? So, and this is the AI ecosystem. We already have some parts of it in this portfolio. Yeah, so thank you. And this is the team and the most important slide, disclosures and disclaimers. So we'll take some questions now.
If you have any questions, you can put them in the chat. Any questions?
Yeah, otherwise, Rohan, you can ask if you think there are some FAQs kind of questions which typically people have in their mind. Just ask and I can answer that, address
Yeah.
that.
So there's this question from Shankar. What is the ticket size and management fees?
Yeah, that I guess you can answer that, right?
Okay. So the fund buy-in starts from 50,000 US dollars and it has 2% management fees. It's not a PMS service. It's a hedge fund.
The Cayman Island fund, right?
Yeah. Yes.
Yeah. So it's an offshore fund in Cayman, and you have to remit your money. If you are doing from India, you have to use LRS. If it's rest of the world, you just transfer to the Cayman bank account and it's invested there. Nvidia, no, Nvidia was not discussed. The first one was Apple. Second one we discussed was Netflix. And the third we discussed was Meta, Facebook.
It's an offline process. Dr. Vikas, regarding reporting and taxation, can you answer that?
Yeah, so reporting the fund will be giving you, right? That what is the performance and so on. If you sell, then of course you use the report at what price you bought, what price you sold, and you apply for your taxation. Taxation for Indian resident, Indian taxpayer is as if you have invested in an unlisted company. Okay. So unlisted company means 2 year holding period is considered long-term capital gains, and less than that is considered short-term. So short-term for unlisted company, you have to pay at your full slab rate. But long-term, it's that 12.5%. Okay. But you have holding period is 2 years in this case. And as long as you hold the units, it's inside whatever is happening in the fund is not relevant to you. Now, this I am giving you as a not as a tax expert, so you have to consult your tax expert. I'm just trying to help out with my understanding. It need not be correct. Okay. See,
There's
Nike, yeah,
Yeah, I was about to
Nike.
ask you the same question, Doctor.
Yeah. So Nike is fine. We looked at it actually when it went down a few months back. It was down after the digital marketing had turned out to be a disaster. But we didn't really think it was a great buy because even at that price, first of all, it didn't look that cheap. Secondly, the growth for these kind of companies is, quite slow. It's still reasonable, 3 to 5 or 6%. But for that, if it to really compete with the other investments, it should have been either very much cheaper or the expected growth should have been much higher. So we didn't go for it. We looked at it very carefully. So the fund performance question you can address, Rohan. Okay. So on the negative performance, so I didn't say negative performance of the stock price. So just to clarify, we are talking about negative cash flows or negative profits, right? So we don't invest in those kind of companies. Consistent negative performance in fundamental manner, right? On the balance sheet and income statement or cash flows. That is what we are saying. Tesla, no. The reason we didn't like Tesla, I'll tell you, we have never had Tesla because it has huge debt initially. Now the debt is cleared up. Secondly, all the profits are coming. If you take out the rebates or the benefits from government, then wasn't much profits. So yes, we wouldn't have Tesla. We are happy to miss that. The stock price can go up. It doesn't bother us. On the other hand, Amazon is very different. Okay, in Amazon, we have done those adjustments. Amazon has been with us for more than 5 years, maybe 7 years. Okay. Uh, the reason we have Amazon is very different. It never had debt. Okay. You you when you analyze the income statement, it looks like it has very small profits, and the price to earnings looks very, very high. But for companies like Amazon, we have an adjustment we do where we understand that a lot of their capex, capital investment, is actually going through the income statement. Okay. So they are spending on R&D, which is actually not to be expended annually. As I mentioned, it lasts for around 5 years. So you should ideally be putting it on the balance sheet, right? So that frees up some earnings, right? So the true earnings are there. Secondly, they also do a lot of marketing and sales spend before the event happens. So whatever, let's say they're targeting some growth, revenues and sales next year, they would start hiring this year itself, a lot of people. And so that expenditure on marketing and sales is happening much before, but it's going to be used for next year. So again, you can clean up, and that way you can get a adjusted balance sheet and adjusted income statement with that kind of analysis, and also things like sum of the parts. So we did some of the parts analysis of Amazon in the US retail business, then the international retail business, and then the third piece was the cloud. So we broke it down into these three and separately valued them. And it was cheaper than that compared to, the sum of the parts. And so it did come into our portfolio, and it was there for a very long time. My understanding is that you will be facing tax only when you sell the units. But that is my understanding. You have to consult your tax consultant. Okay. But my understanding is like that for India, that if you sell the units, only then there is taxation.
Guys, any other questions? Feel free to ask them. Hi, Shankar. We were just talking about few companies at the starting of the presentation. The presentation also will be shared with you after the webinar. Thank you all for joining the webinar. Uh, Thank you, Dr. Vikas, for hosting it and talking a lot on the fund. We appreciate your time. And to everyone, thank you all for joining. If there's anything else, you can just drop an email to customer success at global. One second, I'll just share this. Right, sure. Dr. Vikas, I'll just share my screen.
Please do. Absolutely.
For any queries, additional queries, just reach out to customer success at stockal.com. We'll be happy to, answer questions for you. If you have any more questions or you would like to onboard on the fund, we can take it from there.